Welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined by our Global Head of Macro, Tactical Asset Allocation and Alpha, Haydn Davies. Good morning, Haydn.
Good morning.
Okay, so let's get straight into it. This year, the US economy has surprised forecasters with its strength while still allowing inflation to fall. Has the Federal Reserve managed the impossible in taming inflation whilst avoiding a sharp economic downturn?
Well, it certainly seems that way, doesn't it? So US inflation now is 3%. It's halved over the course of this year, and it's down from a peak of over 9% in the summer of last year. So inflation at 3% is within spitting distance of the Federal Reserve's 2% target. So they've certainly made an awful lot of progress there. At the same time, as you mentioned, growth has been remarkably strong in the US, given the sharp rises that we've seen in interest rates. So at the start of this year, start of 2023, economists were forecasting basically zero growth, a little bit better than zero growth, but essentially zero growth for the US economy over the course of 2023. And it now looks as if the economy will have grown about 2% in the course of the year. So much better than anyone was expecting at the start of the year. And for next year, economists are penciling in growth forecasts of 1%. So weaker, but certainly not a recession or even a sharp slowdown, a slowdown of sorts, but certainly not a sharp slowdown. So from that perspective, it does look as if the Fed has managed what many economists, myself included, would have thought was impossible. And certainly it's surprised the markets to some extent, given the rises in interest rates we've seen as well. Perhaps I should mention one sort of cloud on the horizon, so it isn't all great news, and that is underlying inflation. So economists, investors, market practitioners talk about headline inflation. So that's the inflation figure that everyone is familiar with, but policymakers and the like also like to focus on core inflation, underlying inflation. So this is inflation that ignores the impact of food and energy prices because they're quite volatile. And one of the reasons why headline inflation has come down so much is because oil prices have fallen this year. So core underlying inflation in the US is still about 3.5% to 4%. So not quite as a benign backdrop as the headline figure would have you believe. And the problem is that core inflation seems to have stopped falling in the last few months. And on that basis, there are perhaps some reasons to worry that getting inflation down to the 2% target may take a little bit more work than perhaps the markets are now taking for granted, and perhaps even that the Federal Reserve is taking for granted. But certainly at its December policy meeting, the Federal Reserve certainly maybe gave itself a pat on the back because it certainly changed its tone a little bit. It moved away from warning that interest rates were going to stay at these elevated levels for quite some time to talking about actually cutting interest rates next year. Now, it was very likely anyway that the Federal Reserve would cut interest rates in 2024, but it's the first time the Federal Reserve has pretty much taken off the table any prospect of another interest rate rise and has really highlighted the fact that it doesn't want to wait until inflation is at its 2% target before it cuts interest rates. So the Federal Reserve itself is expecting to cut interest rates by about 75 basis points, so that's 0.75% over the course of next year. And the markets expect even more. So they think that, or they've started to price in that the Federal Reserve will actually cut interest rates by about twice that, 1.5% next year. And perhaps they could do so as early as the spring. If underlying inflation stays stubbornly high, then I think that'll be harder. But certainly in terms of the overriding prognosis, the Federal Reserve will be cutting interest rates. Inflation will be falling. It's just a matter now of how quickly we can get inflation down to that 2% target. And I suppose on a final note, just that if we had asked the question maybe 3 or so years ago, would we be happy, or would policymakers be happy, would investors be happy, would markets be happy with core underlying inflation at 3.5% to 4%, twice the Federal Reserve's target? we'd definitely say no. We definitely would have said no. So it's perhaps it's because we've become used to inflation at twice these levels and peaking at 9% last year. It's perhaps because we've got used to that 3.5%-4% inflation seems pretty good, but by historical standards, the standards of the last 20 years, it's still not very good, and it's twice the central bank's target. So the Federal Reserve certainly has managed to bring down inflation without having a noticeable impact on US growth, and that's to be applauded, but there's still a little way to go.
Thank you. So, like the US, the Eurozone has seen inflation cool sharply, but the same can't be said for the UK. How far behind is the Bank of England in the fight against inflation?
Well, sadly, the Bank of England is far behind, but I suppose that at the same time, the weakening that we've seen in the UK economy ought to be sufficient to bring inflation down to the Bank of England's target of 2%, probably by the end of 2024. So Eurozone inflation, as you highlight, has fallen quite sharply this year. So US inflation started falling first, and the UK and the Eurozone have been behind, and that's partly because of the war in Ukraine and the fact that the UK and the Eurozone have been obviously more affected by the war in Ukraine and the rise in natural gas prices. But certainly this year, Eurozone inflation has fallen very sharply and is now very, very close to the European Central Bank's 2% target. In the case of the UK, inflation has fallen a little bit more sharply in the last few months, but at 4.5% compared to 2.5% in the Eurozone, 3% in the US, it's certainly still the case that UK inflation is lagging behind. And core inflation, again, underlying inflation, which is inflation ignoring food and energy prices, which is usually a better guide of the underlying rate of inflation, in the UK is about 5.5% to 6%. So that's 3 times the Bank of England's target. So certainly that is a concern for the Bank of England. And whilst the Federal Reserve sounded a little bit more pleased with itself at its December meeting and highlighted the prospect of cutting rates in 2024, the Bank of England certainly didn't strike that tone, and even three policymakers on the Monetary Policy Committee actually voted to raise interest rates. So the Bank of England certainly doesn't think its fight against inflation is over yet. But I suppose the weak growth that we're seeing in the UK, also that's true in Europe as well, that will help to bring inflation down, and we ought to see inflation eventually getting to that 2% target next year. In terms of the growth or the growth in interest rate outlook, so because growth is pretty feeble at the moment in the UK, it's pretty much bumping along at zero or a little bit better than zero, it's sort of stuttering along. That will bring down inflation. But the Bank of England's sort of big overriding concern at the moment, and has been for some time, is wage inflation. So wage inflation in the UK is stubbornly high at around about 6.5% to 7%. Now, there is evidence that it's gradually coming down, but the emphasis there is on gradually. And that will make the Bank of England very, very uncomfortable because, of course, as we go into the new year, we get an awful lot of wage settlements. And if those wage settlements are struck at those kind of levels, it will make it very hard for the Bank of England to squeeze inflation out of the system without raising interest rates further. So that's the big worry for the Bank of England. So certainly policymakers will be looking for further cooling in wage inflation, but certainly 6.5%, 7% wage inflation is not remotely consistent with the Bank of England's 2% inflation target. In terms of the interest rate outlook, it does look as if the Bank of England will be able to cut interest rates in the second half of next year, but maybe by about 0.75% to 1% only. But markets and investors and savers will have to wait probably until about the second half of the year for that to start happening. So the Bank of England needs to keep the screws fairly tight at the moment because of the strength of wage inflation.
Thanks, Haydn. So as we get to the end of the year, it's not been a bad year, particularly for those who've been investing in equities. What do we think 2024 holds in store?
No, it hasn't been a bad year for particularly for equity investors. So Investors who invested in global equities, I think, have enjoyed returns of about 15 to 20% in 2023. The UK equity market's up about 8 to 10%. And so, yeah, it hasn't been a bad year for equity investors. And bond investors, well, it hasn't been a great year, but it's certainly been a lot better than was the case in 2022. Looking ahead to 2024, we're more optimistic on the outlook for those who do invest in bonds, and perhaps a little bit more cautious on the outlook for equities, given it's actually been quite a strong year in 2023. Of course, 2024 is going to have, it's going to be eventful. We've got a US presidential election, and with all the razzmatazz that involves, and we also probably have a UK election as well. And in the meantime, there'll be lots of wrangling over the US budget and potential flashpoints in the Middle East, in Ukraine, and possibly even Taiwan as well. So 2024 will have lots of surprises for us, and certainly will make for an exciting ride. Interestingly, the third year of the US president, so that's actually it was Biden's third year in office in 2023. That is usually one of the best years for equities, and the year before an election is usually pretty average. So positive year, but certainly that too would suggest that 2024 is going to be a little bit more restrained in terms of market performance as far as equities are concerned. But looking sort of more broadly, I mean, I suppose the main themes for 2024, inflation should keep falling, perhaps not as quickly as policymakers would like, and interest rates will start falling. But at the same time, we're not going to see interest rates being cut by central banks as sharply as perhaps investors are used to in previous interest rate cycles. So when central banks cut interest rates in 2000 and 2008, they did so very, very sharply indeed. But that was because the global economy was moving into recession, and quite a deep recession in both cases. So we will only see sharp cuts in interest rates if the world economy cools more than expected. So whilst I suppose that's good news for borrowers that interest rates will be coming down. It's the message we're sort of trying to tell people is don't get carried away. Interest rates are coming down, but not as sharply as some of the markets would have you believe. And I suppose if there was any theme for 2023, it was how high were interest rates going to go, because it seemed like central banks were never going to stop at some points. And now interest rates have peaked. I suppose the theme for 2024 it will be how long before they cut, and how quickly will policymakers be able to cut interest rates. And from our perspective, yes, it looks as if interest rates will be coming down, but not particularly quickly and not particularly sharply. But that's still very good news for bond markets. So that's one of the reasons why we're quite upbeat on the outlook for bonds in particular. They had a terrible year in 2022 as interest rates rose. They had a better year in 2023, but we do think that 2024 could be a very good year for bond investors as interest rates do start to come down. And as far as equities are concerned, well, perhaps not as good a year as this year, but still a pretty positive outlook. Growth is probably going to be on the soft side in the first half of the year, but then accelerating in the US, the Eurozone, and the UK in the second half of the year. So it should still be a positive year for investors, whatever you're invested in.
Thanks, Haydn. That's a great detailed update. So thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require guidance or advice, we would recommend you contact your professional financial advisor. Thanks once again for listening to our podcast, and we look forward to speaking with you again soon.